Building long-term wealth in the stock market does not require reading financial charts for hours every day, picking individual hot stocks, or trying to predict the exact moment the market will drop or rise. In fact, attempting to outsmart the broader market usually leads to lower returns and unnecessary financial stress. The most reliable, proven strategy for everyday investors to capture market growth is through broad market index funds. To understand an index fund, imagine the stock market as a massive collection of the largest and most successful companies in the country. When you buy shares of an individual company, your entire investment depends on that single business performing well. If they suffer a bad quarter, your investment drops. An index fund solves this concentration risk by acting as a basket that holds small pieces of hundreds or even thousands of top companies simultaneously. Instead of placing a high-stakes bet on one player, you are investing in the aggregate growth of the overall economy. When you invest in a broad market index fund, such as one tracking the S&P 500, your money is distributed across the 500 largest publicly traded companies in the United States. If a few individual companies struggle, their impact is offset by companies that are thriving. Over decades, the overall market has historically trended upward due to continuous innovation, population growth, and business expansion. By holding a broad index, you automatically capture that long-term upward trend without needing to analyze balance sheets or follow corporate news. The real engine behind index fund investing is compound interest. When you hold an index fund, companies within the index regularly pay out dividends, which are portions of their profits distributed to shareholders. When you set your investment account to automatically reinvest those dividends back into buying more shares, your base investment grows without requiring extra cash out of pocket. Over 10, 20, or 30 years, those reinvested earnings generate earnings of their own, creating an exponential growth curve that speeds up dramatically in the later years. Starting with index funds requires a simple, repeatable process. First, choose a reputable brokerage platform and open an account suitable for your long-term goals, such as an IRA or a traditional taxable brokerage account. Second, set up an automated monthly transfer from your checking account directly into a low-cost, broad market index fund. The key metric to look for is the expense ratio, which represents the annual fee charged to manage the fund. Look for low-cost funds with expense ratios well below 0.1%, ensuring that fees do not erode your compounding returns over time. Once your automated investments are running, the most important step is practicing discipline during market volatility. The stock market naturally fluctuates, experiencing periods of sharp growth, followed by sudden pullbacks. The mistake many beginner investors make is panicking during market drops and selling their shares at a loss. Market downturns are a normal part of the economic cycle, and holding through those periods allows you to automatically purchase more shares at discounted prices through dollar-cost averaging. You do not need complex strategies or immense capital to build significant wealth over time. By consistently buying low-cost broad market index funds, automating your monthly contributions, and letting compound interest operate uninterrupted over long time horizons, you create a durable foundation for financial independence.